Hey everyone, welcome back to Corporate Decoder. Today, IRHOU just filed an 8-K announcing a merger with Electra Vehicles Inc., and I'm seeing some interesting deal terms. Quick note, this is not financial advice, just my take on public filings for educational purposes. This is a pretty standard SPAC merger, but the earnout structure and the post-merger board composition are definitely worth a closer look. So, I.R.H.O Acquisition 2 Corp, you might know them as IRHOU on the NASDAQ. They are a special purpose acquisition company, or SPAC. Their whole purpose is to merge with a private company, taking it public. They have announced they are merging with Electra Vehicles Inc. Electra Vehicles is in the business of battery intelligence for electric vehicles and energy storage systems. Basically, they want to make batteries better and last longer using smart technology. This filing is all about the merger agreement, which is the official document outlining how this deal will happen. It was signed on the 21st of April 2026. Now, before the merger itself, there is something called a domestication. I.R.H.O, which is currently registered in the Cayman Islands, will re-register as a company in Delaware. This is pretty common for SPACs, as Delaware is a popular state for corporate law after that I.R.H.O merger sub Inc. A subsidiary of the newly domesticated I.R.H.O will merge with Electra Vehicles. Electra will be the company that survives, but the parent company, currently I.R.H.O Acquisition 2 Corp, will be renamed Electra AI Incorporated. So, the SPAC essentially becomes the public vehicle for this new battery intelligence company. Let's talk about the money involved. I.R.H.O is agreeing to acquire all of Electra's equity interests for a significant sum. The base purchase price is $250 million, plus something called the Aggregate exercise price, which refers to money paid for outstanding stock options. This total amount will be paid out in the form of newly issued I.R.H.O shares. These shares are valued at $10 each for the purpose of calculating the merger consideration. So if the base purchase price is $250 million, that means roughly 25 million shares of the new company will be issued to Electra shareholders as part of the deal. There is a detail that limits how many of these shares can be Class B stock, but overall, expect a large chunk of the future Electra AI Incorporated to be held by Electra's original owners. So, what does this mean for existing I.R.H.O shareholders and Electra shareholders? Well, Electra shareholders, including those holding preferred stock, common stock, options, and convertible notes, will receive a combination of newly issued parent class A common shares and parent class B common shares. The exact amount each person gets depends on a conversion ratio, which is basically a calculation based on the total merger consideration and the total number of Electra shares outstanding. Importantly, there is a mention of earnout shares. This means Electra shareholders might get even more shares in the future, depending on how the company performs. This is a pretty interesting part of the deal. The original Electra shareholders could earn up to an additional 15 million parent common shares. Think of these as bonus shares for hitting certain performance targets after the merger. These bonus shares are split into 3 potential milestones, each worth 1/3 of the total bonus pool. The first milestone can be achieved in one of 2 ways. Either the average trading price of the parent common shares over a certain period needs to hit $14, or the company's annual run rate, or ARR, needs to reach $45 million. The ARR is basically the company's recurring revenue for the year. So, if Electra can either get its stock price up to $14 or hit $45 million in AR, a third of those bonus shares become available. The second milestone is similar but with higher targets. The stock price needs to reach $16 or the AR needs to hit $55 million. This milestone is measured 1 year after the closing date. And the third milestone is even more ambitious. The stock price target increases to $18 or the AR needs to reach $65 million. The key here with these earnout shares is that they are designed to incentivize the new management team and original Electra owners to grow the company's value and profitability. If they hit these targets, it means good news for shareholders as well. Looking at leadership, the board of directors of the combined company will have 7 members. Electra gets to choose 5 of them, and the remaining 2 will be agreed upon by both Electra and the original SPAC sponsor. This strong representation for Electra's existing team makes sense, as they are the ones running the operational side of the business. On the executive side, Fabrizio Martini will be the Chief Executive Officer and Nicholas Chakalos will be the President and Chief Operating Officer. So, the leadership is clearly coming from the Electra side. The agreement also includes standard clauses about how both companies need to behave before the deal closes. Electra has promised to provide its audited financial statements for 2024 and 2025 by May 14, 2026. These will be crucial for the registration statement that needs to be filed with the SEC. For this deal to actually happen, a few things need to fall into place. Both sets of shareholders need to approve the merger. The registration statement filed with the CC must become effective. The new company's stock needs to be conditionally approved for listing on the NASDAQ. There also can't be any major negative events affecting either company. A significant condition is that the company needs to have at least $30 million in cash at closing. This is a vital number for SPAC deals, ensuring the company has enough capital to operate post-merger. Of course, deals can fall apart. The merger agreement can be terminated by mutual agreement, or if the closing doesn't happen by a certain date, which is set as the 21st of January 2027. There are also provisions for termination if there is a material breach of the agreement by either party or if the deal becomes illegal. Beyond the main merger agreement, there are other important documents. First is the Parent Support Agreement. This is an agreement between the SPAC sponsor, I.R.H.O Acquisition II Corp, and Electra. The sponsor essentially agrees to vote their shares in favor of the merger and to not interfere with the deal in any way. They also can't sell their shares for a period of time without Electra's permission. This prevents the sponsor from dumping their shares right after the merger and helps ensure a more stable start for the newly public company. Then there is the Company Support Agreement. This involves Electra and certain of Electra's major shareholders. These shareholders are agreeing to vote their shares in favor of the merger, and similar to the sponsor, they are restricted from selling their shares for a period after the deal closes. Following on from that is the Lockup Agreement. This is a standard practice in these types of mergers. It means that certain shareholders, including those of Electra and the SPAC sponsor, will have their shares locked up for a period after the closing date. The release of these shares is staggered over 4 equal quarterly installments. Starting after the company issues its first quarterly earnings release that is at least 120 days after the closing. This is another mechanism to prevent a flood of shares hitting the market all at once, which could depress the stock price. Finally, there is the Registration Rights Agreement. This agreement basically gives certain shareholders the right to have their shares registered with the CC for resale. This is important because it allows these shareholders, including the original Electra stockholders and the SA sponsor, to sell their shares in the public market without needing to go through a separate registration process each time. This agreement will typically terminate either 5 years after it is put in place or when a shareholder no longer holds any registrable securities. This section confirms that the shares being issued as part of this merger are not being registered under the Securities Act. This is allowed under certain exemptions like Section 4, I.R.H.O of the Securities Act for private placements to institutional investors or accredited investors. This part just refers to a joint press release issued by I.R.H.O and Electra regarding the business combination. It is important to remember that this information is being shared broadly to comply with regulations and avoid giving unfair advantages to any one investor. This is a standard legal disclosure telling investors where they can find more information about the deal. They'll be filing a registration statement on Form S-4, which will include a preliminary proxy statement and prospectus. This document will contain all the crucial details for shareholders to make an informed decision about voting on the merger. This section clarifies who might be considered a participant in asking shareholders to vote for the merger. It includes directors and executive officers of both companies. This is a very important section in any SEC filing. It basically warns investors that many of the statements made in the report are not facts about the past but are predictions about the future. Words like believe, may, will, and anticipate are often used to signal these statements. They are based on current expectations and assumptions. But actual results could be very different due to various risks and uncertainties. This section is essentially a disclaimer to protect the companies from lawsuits if their future predictions don't come true. They specifically mention that they won't necessarily update these statements if things change. This is another legal disclaimer stating that this document is not an offer to sell or buy any securities. It is simply providing information about the proposed merger. This is the list of all the documents attached to this filing. You can see the merger agreement itself, the proposed new company charter and bylaws, the support agreements, the lockup agreement, and the registration rights agreement. Among others, the press release is also included here. Now, let's put it all together. This is a typical SPAC merger. I.R.H.O Acquisition II Corp is acting as the vehicle to take Electra Vehicles public. The deal value is substantial with a base purchase price of $250 million, and it is paid for with stock. The earnout structure is a key element, providing upside for Electra's original shareholders if the company performs well. This is a common way to bridge valuation gaps between a SPAC and a target company. The leadership and board structure clearly favors the Electra team, which is expected in this kind of transaction. The main risks typically lie in the execution of Electra's business plan post. merger and whether the company can achieve the revenue and stock price targets needed to unlock those earnout shares. A comparable SPAC merger that saw similar post-merger earnout structures is often designed to align incentives, but the ultimate success hinges on the operational performance of the acquired company. If Electra can't grow its R or boost its stock price, those earnout shares just won't materialize, similar to how other SPACs have struggled to meet investor expectations. The $30 million cash condition at closing is also a critical hurdle. These deals often face. That is my take. Stay decoded. If you want the broker and charting tools I use day to day, they are linked below. Grab a free sign up if you want to support the work.